Ever watched a stock plummet and thought, if only I could have bet on that? Well, you can. Most investors buy stocks hoping the price goes up, their team buy. But what if you spot a company that's overvalued or headed for trouble? That's where short selling comes in. Short sellers bet on a stock's decline. It's not about rooting for failure. It's about seeing weakness others miss. The market is a two-way street. You can profit when stocks rise or fall. Short selling is the art of making money from a stock's drop. Instead of buy low, sell high, you sell high, buy low. Here's how you sell shares you don't own, hoping to buy them back cheaper later. Imagine selling your neighbor's lawnmower for $100, then buying the same model for $50 to return it. You pocket the difference. That's short selling in a nutshell. Selling what you don't own, aiming to buy it back for less. It takes research, conviction and guts. You need a solid reason to believe a stock will fall. Bad earnings, a failed product or industry headwinds. Guessing isn't enough. You need to be a detective, spotting clues others ignore. Get it right, and the rewards can be spectacular. Ready to see how the pros do it? Let's break down the mechanics. Short selling starts with your broker. You can't just sell shares you don't own, they must be borrowed. Your broker finds shares from other investors willing to lend them for a fee. You instruct your broker to short 100 shares of company X at $50 each. The broker borrows and sells them, crediting your account with $5,000, but you owe those 100 shares back. Now you wait, hoping the price drops. If the stock falls to $30, you buy back 100 shares for $3,000. The shares are returned to the lender. You sold for $5,000, bought back for $3,000, netting a $2,000 profit minus fees. But if the stock rises, you'll have to buy back at a higher price, locking in a loss. Short selling is a high-stakes bet against the market. The process is simple, but the risks are real. So what happens when things go right or very, very wrong? So let's see short selling in action. Imagine it's early 2025 and you believe Publicis Group is about to stumble. You short 100 shares at $90 each, $9,000 in your account. Publicis releases bad earnings and the stock drops to $70. You buy back 100 shares for $7,000, pocketing a $2,000 profit. You made money as the stock crashed, contrarian victory. But what if you're wrong? Suppose Publicis lands a huge contract and the stock soars to 110. Now, buying back 100 shares costs $11,000. You sold for $9,000, but must buy back for $11,000, a $2,000 loss. Worse, if the stock keeps rising, your losses grow with every tick. Short selling can be thrilling, but the risks are enormous. The market can humble even the smartest traders. That's why understanding margin is crucial. Let's talk about how margin works and why it can be dangerous. The stakes just got higher. Margin is borrowed money from your broker, letting you leverage your trades. When you short a stock, the sale proceeds are held, but you must also put up collateral, your margin requirement. Your broker constantly monitors your account to ensure you have enough equity. If the stock rises and your equity falls below a set level, you get a margin call, a demand for more money, fast. You can either deposit more funds or close your position and take the loss. If you don't act, your broker will close your position for you, selling assets to cover the debt. The broker's priority is protecting their firm, not your portfolio. Margin amplifies both gains and losses. It's a double-edged sword, powerful but dangerous. Leverage trading can wipe you out quickly if you're not careful. The house always protects itself first. That's the brutal reality of shorting with margin. Now let's look at just how bad things can get. When you buy a stock, your maximum loss is what you invested. But when you short, your losses are unlimited. A stock can only fall to zero, but it can rise forever. Short at $10, and if the stock jumps to $50, you lose $40 per share. If it rockets to $100 or more, your losses keep climbing. This risk is magnified by a short squeeze when rising prices force short sellers to buy back shares, driving the price even higher. It's a vicious cycle margin calls trigger more buying, which pushes prices up further. In a full-blown squeeze, fundamentals don't matter, panic takes over. You're no longer betting against a company, but against human psychology. Even big hedge funds can be wiped out in days. The ultimate cautionary tale, the Volkswagen short squeeze. Let's see how one hidden variable can turn a sure thing into disaster. The risks are real and sometimes historic. Here's what happened with Volkswagen. In 2008, Volkswagen briefly became the world's most valuable company, thanks to a massive short squeeze. Hedge funds bet big against VW, convinced it would fall. But Porsche secretly bought up VW shares and options, amassing control of 74% of the company. The German government held another 20%, leaving just 6% of shares available to trade. Short sellers had borrowed more shares than were available. When Porsche revealed its stake, panic erupted. Short sellers scrambled to buy back shares at any price. VW's stock soared from 210 to over 1,000 in 2 days. Hedge funds lost billions, fortunes vanished overnight. It was a bloodbath, a brutal lesson in the dangers of shorting. Even the best research can't protect you from hidden risks. One surprise can turn a winning bet into financial ruin. So, what should you remember before you ever short a stock? Should you ever short a stock? Maybe, but only with extreme caution. First, do your homework. You need a solid evidence-based reason to bet against a company. Understand the business, the risks and the market. Second, respect the risk of unlimited losses. Never bet more than you can afford to lose. Use stop-loss orders to limit your downside. Third, watch short interest. If too many are short, a squeeze can happen fast. Crowded trades are dangerous. Sometimes it's best to avoid the herd. Remember, markets can stay irrational longer than you can stay solvent. Shorting is a bet against optimism and momentum. Be careful, be smart, and never underestimate the market's power. Know the risks, respect the game, and don't play with fire unless you're ready to get burned. Short selling isn't for everyone, but if you try, do it with eyes wide open. And always, always do your homework.